So what I wanted to talk to you about this evening is to give you an example of the kind of financial planning that we do with a typical client in helping them look at their objectives and the goals that they've got for the future, help them work out when it is they can afford to retire, if they can afford to retire, and what plans they need to put in place to get there. It's very important when you start off on this journey that you have this sort of end game in mind, that you know where you want to get to, and then building a plan to help you get there can give you the reassurance that everything's on track, and you can then relax and get on with the other important bits of your work and your life, knowing that the financial side of it's as taken care of as it can be. So what I've done is I've put together an example fact find and financial plan. I've used your name with your kind permission, but all the figures in the thing I'm going to show you now, the program I'm going to show you, have all been sort of made up. So the starting point, and this is on the assumption that we've kind of already had a meeting where we've gathered a lot of facts and information about yourself and your current income, expenditure, and needs, etc., going forward. And with all that information, I put it all into the computer programs that we use and the software to do the projections. And what we're doing today is explaining all this to you. Obviously, as I said, I've kind of made these figures up, but please feel free to ask any questions.
Thank you. Yeah.
So the starting point, Lindsay, from the information you gave me when we had our initial meeting was where you are at the moment in terms of your current assets and what you own. And we'd established that you had bank accounts with around £10,000 in. You have a personal pension that you've been saving into for a good few years, and that's built up a fund of roughly £40,000. You also told me that you have your own property, which you own, and the value of that's approximately £250,000, and you've got a £75,000 mortgage on that, which you expect to be repaid by the time you retire. We did discuss your retirement objectives, and for the purpose of this exercise, you indicated that you saw yourself retiring at about 70.
Yeah.
This is a fairly simple plan that we're building. Obviously, a lot of people out there will have a lot more than this in terms of different plans, policies, bonds, all sorts of stuff. And obviously that could be built in to show a more accurate picture depending on people's situation and circumstances. Before we move on to the next stage, I wanted to talk a little bit about pensions, because that's probably the more complex area of savings and investments that people need a bit of clarification on. And I know it's something we've discussed. So I'm going to open up a little bit more detail on your pension to explain how that works at the moment and the kind of projections and what we can look at for pensions in general. So the pension you've got at present, we're assuming that you carry on with your contributions, and based on the current information we've got, you're currently paying in £250 per month into your pension policy. And you'll carry on doing that, as it says here, up until your desired future lifestyle, which is your current retirement age of 70. The fund value you've got is £40,000, and we've made an assumption that that's going to grow by 5% per annum between now and effectively age 70. And the percentage growth rate we use in your pension, as with any investment, has a huge effect on what you might actually get at the end of it. And I'll kind of demonstrate that in a second. The benefits projecting forward, assuming that you carry on contributing £250 per month level between now and retirement age, suggests that you'd have a total pension fund available at retirement at 70 of £281,000, which would enable you to take up to £70,000, which is 25% of the fund, tax-free. Now, you can actually access your tax-free cash anytime you want with your pension after, well, currently it's the age of 55, but that is increasing to 58 in 2026. Sorry, it's 2028. It's going up to age 58. Yeah, you can. So the way that it works is once you start taking your tax-free cash from your pension pot, which you say 55, 58, and that could change in the future, then you you can still carry on contributing to your pension and building the fund up. And any money that you put into your pension fund after you've taken the tax-free cash, you can still take tax-free cash on that because it's money, new money. It basically forms two pension pots, a crystallised and an uncrystallised pension fund.
Oh, okay.
So you can take out tax-free cash. The other thing you can't do, or can cause problems, if you start taking some of the taxable income, then it restricts how much you can put in going forward. So the drawdown table gives an example of how that might look at retirement, although it's very flexible. You don't need to quite do this. At 70, it's saying that if you wanted to maintain a level of income the same each year between 70 and age 100, you could take out the equivalent of £13,300 per annum. That's after your £70,000 tax-free cash, and that would last you until you get to age 100, by which time you'd run out of money. But you don't need to take it all that way. You can take a greater amount in the early years and less later on. What I wanted to show you quickly before I move on, and I'll ask you if you've got any questions before I do, is the difference that 1% growth makes to the fund. If we increase that to 6% and apply that to the growth figures, and then we go back into benefits, that 280,000 you had is now 340,000.
Oh, right.
Just for a 1% difference in growth. That £70,000 tax-free cash becomes 84,000 tax-free cash. And that income becomes 17,887 a year, as opposed to 13,000 a year.
Wow.
And that kind of illustrates the difference that 1% growth makes. Now, it can also work the other way. 1% less, of course, will have an equal negative effect.
Yeah.
But the investment strategy going forward is very important, obviously, in terms of maximising the growth, because that ultimately will make a big difference. Obviously, the shorter the period of time to retirement, the less impact that would have. But for the time being, I'm going to change that back to 5%. And we use 5% because it's a kind of an achievable growth rate and of a sensible level of risk for most people. I say some people will get better than that, and to be fair, some people less if they take less risk. The next section we need to look at is we've got what you've got at the moment is looking at your income and expenditure, because projecting those forward is very important. Now, based on the discussions we had, we'd calculated that your self-employment basically was about £50,000 per annum is what you earned, net profit as self-employed editor. We've got allowances of £3,000. That's the tax allowances you're getting on your pension contributions, and obviously saving pension tax on those pension contributions. In fact, for every personal pension contributions, for every £100 you put into your pension pot, the government also put the £25 in. And if you're a higher rate taxpayer, you can claim back an additional £25 because you're a higher rate taxpayer as well. So they're very tax efficient. That allowing for tax at the moment, if we've got the figures right, is saying that after income tax has been paid and national insurance has been paid, you should have spendable income, an average of about £3,276 per month, or just short of 40,000 a year, or £756 a week, how we want to do it. But that's the kind of the rough budget that you would have available as income coming in at the moment.
Great.
Yeah, okay with that. Good. We'll go so far. So then we look at your expenditure, and based again on the information that you gave us when we went through detailed expenditure of what you spend, you were spending about £27,000 a year, and that's made up of £2,300 per month that you'd expect to spend, and that's index linked because it'll go up each year with inflation between now and your intended retirement age. And then when you retired at 70, you felt that you perhaps need about £1,800 per month in today's terms. On top of that, expenditure wise, we've also got your personal pension contributions. We've got your mortgage payments, which is £4,200 per annum, and your tax and national insurance. So it means you're spending £45,564 a year on average out of the income you've got, which gives you a surplus of about £4,436 a year unallocated income in terms of you spend on what you want,
Yeah.
in addition to what you're already spending there.
Like on holidays or whatever,
Yeah.
like that. Yeah.
Holidays, changing your car, additional savings. And what,
Right.
what the computer assumes going forward to produce the cash flow is that this surplus, though, it's been saved, because as far as the computer is concerned, if you either spend it or save it,
Yeah.
you can't. There's only two things you can do. So if you're not spending it, you're saving it, and the computer says, well, you're saving that, we're going to put that into a savings vehicle of some description going forward, and we're going to assume you're going to get about 5% a year return on that, and that's going to add to your pot for retirement, whether it's savings through the pension or other kinds of savings and investments. Then what the computer does, it very cleverly brings all that together in terms of our lifetime cash flow. So when it's done its calculations, what it's showing you here is a graphic illustration of your income and expenditure between now and age 100. So the grey bars are what you have got income coming in at the moment, which is it's level because it's assuming inflation, so it's assuming the same level all the way through. I'll show you the effects of inflation a little bit later on. It does increase when you get to 67 because your state pension will come in then. So you've got your current working and then your state pension. And then this big grey spike here is assuming you take all of your tax-free cash when you retire. And so that extra 80,000 comes into your savings account. Now, you might not take all that in one go. You might just take some of the tax-free cash and spread the rest out. But for the purpose of the exercise at the moment, we're assuming you take your tax-free cash and you put it to one side. So what the computer then does is it says, well, we know where you're starting from at the moment. You've got about 40,000 in pensions and 10,000 in savings. So excluding your house, you're worth about 50,000. But between now and age 70, all this, you're going to save £250 a month into your pension, plus all this surplus cash that you're earning that you're not spending, you're also going to save. And then it puts it into a chart, basically, which we call a capital chart, which shows you now that this is where you are at the moment at £50,000. Assuming the savings and the growth rates, by the time you get to age 70, you'll have in today's terms the equivalent of about 320,000. That in reality is more than that, but this is all in today's terms. It always puts things in today's terms to put it in terms of inflation proofed. And then once you get to 70, your income stops and all you've got to live on are your personal pension, your state pension and your savings. And of course, your state pension and your personal pension won't be enough, as we've seen on the chart before. So you start to spend your savings, which is what it's there for.
Yeah.
And then if you saw this based on the expenditure would suggest that by the time you get to age 100, you'll have run out of money. And that's fine. So just to show you some of the figures behind the scenes, if you will, to how we've come to these conclusions, because any computer program, any advice we give like this is only as good as the information that we put in. If the information is wrong, the output's going to be wrong. And then I'll just show you a few tweaks that we can do on here. So if we go back from the outgoings to the assumptions, this is basically the assumption we put into the computer and this fairly simple cash flow model that we've built. So we've got your tax-free cash coming in at 70, which will be just over 70,000. Remember, that's assuming 5% growth. Your self-employed income of 50,000, we're assuming a growth rate of 3.5% per annum until you get to age 70. So it's sort of end of 69, that stops. We've got your drawdown income from your pension, assuming you're going to take a level amount up to 13,318, and your state pension at 67 would be 19,906. Now that sounds quite high, but that's after inflation's been applied. So by the time you get to 70, which is a long time off, we know that will be the equivalent of the state pension today, which is just over 8,000 a year, be 19,000 by the time you get to age 70. Assuming, of course, that the government are still doing state pensions by the time you get to 70, and I'm sure they will be. And then on the outgoing side of it, your outflows, general expenditure at the moment is 27,600, plus your mortgage of 4,200, which should finish based on the calculations by the time you get to 68. That's the repayment schedule we've looked at based on your current contributions and everything else. which is good in time for retirement, and your personal pension contributions of 3,000, but of course they'll stop as well at 69 when you actually retire for your 70th birthday. So then when you get to 70, your expenditure in today's terms would be the equivalent of £51,000 a year. Now, if you remember what we said when we went through the expenditure section of the fact find and the information, you were projecting a need of, say, £1,800, £800 per month.
Yeah.
So allowing for inflation at 3.5%, £1,800 per month would be the equivalent of a pension income of £51,000 per annum when we take inflation into account. And we're assuming that's what you get at 70. And again, it's index linked at 3.5% until you get to 800. What we can do with this going forward and our planning is we can adjust things very easily. So at the moment, if you notice at the bottom, we've got desired future lifestyle. I don't know if you can read that or not on the screen.
Yeah.
But that's pointing to age 70 at the moment. If, for example, you say, well, you know what, I don't really want to go to age 70. Can I retire at 65? If we move that along, the computer very cleverly does all the calculations behind the scenes and recalculates it. Now, this then is a cash flow at 65 based on exactly the same assumptions, but obviously you've not got as long to save. 5 years less of savings effectively, and 5 years more to fund as well in that respect. So this is then showing the computer saying, well, basically at 83, you're going to run out of money.
Yeah.
If you carry on spending at that £800 from 70 that we've said.
Yeah.
Now, it's not as bad as it looks, because you're 83 then anyway, you might better cut back. You've also got your house, which we haven't taken into consideration. So you could theoretically do an equity release, and you could maybe move a bit of cash from that. Or you could look to maybe save a little more, spend a little less, earn a little more. There's a lot of variants that we can do to do that. But we can play around, or we can move it up and say, well, let's just move it up to, say, 63. Sorry, 68, sorry, not 63. 68, you're kind of there or thereabouts. You're going to run out at about 92, 93. Now, you might say, well, you know what, if I've got to 92, 93, happy days. I'm not going to worry too much about what I've got left in the bank, and I'll spend the kids' inheritance from the house, you know, if I'm so desperate at that age. But there's a lot of flexibility. We can also adjust things by increasing returns. We already mentioned that before. So again, if we go back to your pension, for example, and we leave that, well, let's move that back to 65. We'll just show one little example of changing one item again. And I go back to assumptions, it's a pension. So what I'm going to do is I'm going to change the fund growth from 5% to 6%. And then we're just going to see, just out of curiosity, what impact that has on the capital chart at 65. And we've just got slightly higher there at 65. Let's go to 70, which has worked okay. Yeah. So what that's showing you there is that there's an increased sum at the end, and you could probably go a year earlier, I would think, on that. Yeah. So if you've got an extra 1%, gives you an extra year's retirement, basically. Well, if I'm doing a financial plan and cash flow for a client at this sort of level, based on obviously not just an individual but partners, and taking all the information into consideration, then we would charge a one-off fee of £500 for that.
Brilliant.
And obviously we could potentially give advice going forward on other aspects of financial planning, investments, etc. But that's kind of a separate thing, really. The starting point for most people, to be honest, is to get a financial plan in place, and then it can be taken from there, really. A typical example perhaps would be that if we see a client for the first time, we do obviously a financial plan for them as part of the process. If, as a result of that financial plan, there's investments involved, and in all probability there is for a lot of clients, then we have a separate wealth management program, if you will, that we can look after those investments and advise on the suitability of the investments, the portfolios, the returns, and everything else. And we work with the client then to build that portfolio and to make sure that they're getting the best returns they possibly can, taking account of the risk and the needs they've got and everything else. And once that plan's been put in place and implemented, so we've got the cash flow as a starting point, then we've got their investments that we look after and make sure they're doing as well as they can be doing, and we review those individually on a quarterly basis. But then we have annual reviews with our clients where we will revisit the cash flow to see what's changed, if anything, make any alterations. We review their investments against the plan. So if we projected a growth rate of, say, 5%, 6, 7, 8%, depending on the level of risk, how are they doing against that plan? Are they on track? Are they achieving and getting what they want from their investments and the returns? And invariably throughout life, and things will change. You set out any journey and there's bound to be changes. So everything's adaptable. And a lot of the things we do with clients and the value we add to clients is being with them on that journey, helping them to stay on track. Also, if the investment markets happen to drop a little bit, to hold their hands and say, don't panic, don't disinvest at the wrong time. There's a lot of things we can do to help and reassure clients. So we kind of work with them on the journey, and we think that's very important. So it's up to the individual. I have some clients that will come to me, they'll want a financial plan and initial advice, and they're happy to go off on their own, and that's absolutely fine. If clients want to stay with us on an annual basis, then we're happy to do that. And obviously there are charges ongoing for that, but we feel they're very competitive. But again, there's no obligation at any point of the process for any clients. They can stay, go, or whatever. It's never too late to start saving for a pension, basically because pensions are one of the best forms of savings you can have anyway, because of the tax implications. So it's always a good thing to save into. Obviously, the more you've got, the better. The sooner you start saving, the better. But yeah, it's never too late. And everybody's situation is differently. We have clients with very little in pensions. We have clients with an awful lot of money in pensions. It's everybody's different.